Build Wealth Now News, or BWNN, welcome back. I'm your host, Billy Bob, and I am thrilled to be joined by Sarah, our star market analyst, CFA, and chartered market technician. Sarah, thanks for being here.
Absolutely, Billy Bob. Always a pleasure to break down the markets with you and our viewers.
This week, everyone's talking about sector rotation, money flowing out of megacap tech and into more value-oriented, stable sectors. And one sector lighting up, healthcare. Not just in headlines, but in the numbers. You've been tracking this using the relative strength matrix on S&P 500 exchange-traded funds, or ETFs. Give us the big picture.
Sure thing. Let's start with XLV, the Healthcare Select Sector SPDR fund. When we run the relative strength calculation across multiple look-back periods, here's what we see. 63-day, 3-month relative strength, 87%. Strong short-term momentum. 126-day, 6-month relative strength, 90%. Accelerating outperformance. 252-day, 1-year relative strength, 90%. Consistent leadership. 504-day, 2-year relative strength, 77%. 756-day, 3-year relative strength, 79%. 1,260-day, 5-year relative strength, 85%. This isn't a flash in the pan. The RS line has been rising steadily since late 2023, and it's now in the top quartile of all S&P 500 sectors. That tells us institutional investors are rotating in with conviction and duration.
So it's not just traders chasing a trend, it's sustained institutional demand. And within that, two names keep popping up: Universal Health Services, UHS, and Amneal Pharmaceuticals Class A, AMRX. Let's start with UHS. Walk us through the financials.
Happy to. UHS is a dual segment operator, acute care hospitals and, more importantly, behavioral health facilities, which actually generate 85% of their segment profit, despite being only 54% of revenue. That's key. Now let's look at the per share fundamentals from their latest Q2 2025 10Q, June 30th, 2025. Sales revenue per share, $58.92, based on 63.4 million diluted shares. Earnings per share, GAAP, $3.42 LTM, or last 12 months. Gross profit margin, 32.1%. Operating profit margin, 4.0%. Net profit margin, 2.6%. Free cash flow per share, $12.47 LTM. Current ratio, 1.85. Quick ratio, 1.62. These aren't flashy margins, but they're stable and cash generative. And notice that free cash flow per share is 3.6 times higher than earnings per share, a sign of high quality earnings and low capex needs relative to cash flow.
That free cash flow is impressive. What's driving that efficiency?
Two things: high bed utilization in behavioral health, which runs like a high turnover standardized care model, and strict working capital discipline. Their DSO, days sales outstanding, has dropped to 48 days, down from 53 a year ago. That's faster cash conversion. Also, their current and quick ratios are healthy, well above 1.0, so they're not liquidity constrained, even with $5.7 billion in debt. And importantly, interest coverage is 4.8 times, so they're not in distress.
All right, now let's pivot to Amneal Pharmaceuticals, AMRX. Totally different business model, generic drug manufacturer. What's the story there?
Yes, AMRX is higher risk, higher potential reward. They've been restructuring aggressively, cutting costs, exiting unprofitable products, and focusing on specialty generics and biosimilars. Here are their latest LTM fundamentals. Q2 2025. Sales revenue per share, $6.14, based on 308 million diluted shares. Earnings per share, GAAP, 11 cents. But importantly, adjusted EPS is 38 cents, showing core profitability. Gross profit margin, 38.5%, up from 34% last year. Operating profit margin, 5.2%, first time positive in 3 years. Net profit margin, 1.8%. Free cash flow per share, 42 cents. Current ratio, 2.1. Quick ratio, 1.4. Now, these margins are modest, but the trend is what matters. They've gone from negative operating income in 2023 to positive in 2024 and 2025. That's a turnaround signal.
And the balance sheet?
Cleaner than it's been in years. Net debt over EBITDA down to 2.9 times from over 6 times in 2022. They refinanced high-cost debt, and current ratio of 2.1 means they can cover short-term obligations twice over. The quick ratio of 1.4 shows they're not over-reliant on inventory.
Technically, how's AMRX shaping up?
This is where it gets exciting. AMRX spent 3 years in a downtrend, but in March 2025, it broke above its 200-day moving average on 3 times average volume. Since then, 63-day relative strength, 83%, one of the strongest in healthcare. 126-day relative strength, 90%. 252-day relative strength, 91%. Still catching up, but accelerating. The RS line versus XLV is now rising steeply, meaning it's outperforming even its own sector. And the MACD just crossed bullishly on the weekly chart. If it clears $4.65, that's a multi-year breakout.
So comparing the two, UHS is the steady compounder, AMRX is the turnaround play?
Exactly. UHS offers defensive cash flow, behavioral health tailwinds, and low volatility, perfect for core holdings. AMRX is a speculative rebound play with significant upside if execution continues, but it's sensitive to drug pricing, FDA decisions, and earnings surprises. From a portfolio construction standpoint, UHS is your foundation, AMRX is your satellite, maybe 5 to 10% of a healthcare allocation.
Let's bring in the analyst consensus. We've got Zacks Research and Simply Wall Street data on screen. For UHS, Zacks gives it a strong buy rating with a consensus price target of $247.81. That's plus 20.73% from today's close. And Simply Wall Street says it's 8.6% undervalued at $245.47. That's a very strong alignment.
It is. And note the good agreement level. The 15 analysts covering UHS have a tight range around their targets. That suggests confidence in the company's ability to deliver steady growth. The Zacks chart also shows positive EPS revisions for Q1 and Q2 2025, which confirms the operational strength we saw in the 10Q.
And for AMRX?
Zacks has it at a hold with a price target of $10.50. That's plus 32.58% from today's $7.92. Simply Wall Street agrees, putting its fair value at $13.50 or 11.5% undervalued. Again, the agreement is good among the 4 analysts, which is solid for a smaller cap turnaround stock.
But wait, here's something fascinating. We've pulled up the discounted cash flow models from Simply Wall Street for both stocks. For UHS, the DCF model estimates a fair value of $652.58, which means at $224.41, it's trading at 65.6% below its intrinsic value. That's a massive gap.
That's right. And it's based on 17 analysts' inputs into the DCF model. It assumes continued modest growth in same-facility admissions, stable margins, and disciplined capital allocation. The model doesn't require heroic assumptions. It just values the company for what it is, a highly predictable, cash-generating machine with a durable business model. That's why the discounted cash flow valuation is so much higher than the current price.
And for AMRX?
The discounted cash flow model for AMRX is even more dramatic. It assigns a fair value of $69.18. Yes, $69. At today's $11.48, that's an 82.7% undervaluation. This is based on 4 analysts' inputs, and it assumes successful execution of their turnaround plan, including margin expansion, debt reduction, and growth in specialty generics.
That's enormous. So are we saying these stocks are massively mispriced?
Not necessarily mispriced, but underappreciated by the broader market. The DCF models are long-term fundamental views. They don't reflect short-term sentiment or macro risks, but they do tell us that if either company executes its plan, even moderately well, the current prices could represent a significant opportunity. For UHS, the gap suggests the market is underestimating the durability of its behavioral health moat. For AMRX, it suggests the market hasn't fully priced in the potential of its turnaround.
Final question. What should investors watch for in the next 60 to 90 days?
For UHS, watch Q3 earnings, late October. Focus on same facility behavioral admissions and labor cost trends. Also, any update on debt reduction. For AMRX, the Q3 call will be critical. Look for confirmation of positive EBITDA in all segments and guidance raised. Also, monitor insider buying. We've seen 2 Form 4 filings this month from directors. And broadly, keep an eye on XLV's relative strength metrics. If the 252-day RS stays above 70%, this rotation has legs.
Sarah, you've given us a masterclass in blending technical signals with deep financial metrics. BWNN. If you found this helpful, smash that like button, subscribe, and drop a comment. Are you leaning toward UHS or AMRX right now? Sarah, thank you for your brilliance.
Thanks, Billy Bob. And remember, strong relative strength tells you when to look. Strong fundamentals tell you why to stay. And discounted cash flow tells you how much it's worth.
BWNN is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. The business phase growth chart is taken from Stock Simplifier. Please note that investing carries its own risk, and you should do your own research before committing any stocks to your own portfolio. Until next time, this is Billy Bob signing off from Build Wealth Now News. Trade safe.